Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now on the show today, we're observing a unique interplay of factors in the markets, a notable shift in the Federal Reserve's approach as we move past peak inflation, juxtaposed with the resilience of the U.S. job market despite a global economic cool down. Now the question on every investor's mind is how do these dynamics will shape the market and what it means for future investment opportunities. Of course, our guest today has over 40 years of experience advising high net worth clients and knows a thing or two about the markets and investment strategies. Ted Oakley, managing partner of Oxbow Advisors, joining us today. Ted, thanks for coming on today to explain all of this to us.
Well, I'll try anyway, Jeremy.
I appreciate that. Let's start a little bit here with the U.S. GDP growth. It's expected to slow to around 0.7% in 2024, down from a better than expected 2.8% in 2023. I'm curious, though, how should investors interpret this slowdown, and what are you watching for, and what investment strategies might be the most effective in this environment?
Well, Jeremy, it's a tough environment in some ways because you have mixed signals in many things, actually. In some respects, you've got a recession going on in commercial real estate and starting to happen in family and on that side of things. On the other side, you had a little bit better economic news. For us, it hasn't really changed anything. I mean, prices were and still are really expensive relative to what you're getting in terms of the stock market. But I think it's been a pretty fake market too, because if you look at a lot of the stocks, I'd say 90% of the stocks outside of the big stocks, the big 7 or 8 or 9, really haven't done that well at all. So I think people are probably a little confused about it, but for us, it hasn't changed what we do a lot, I'll have to say.
Yeah, I'm curious. I mean, the slowdown might present a buying opportunity in certain undervalued sectors. So do you see a potential in any specific areas despite the overall economic deceleration?
Well, I would say, Jeremy, we still think energy is cheap. I know people write it off, but there's a lot of great energy plays you can see out there. And then you can get over on the side of the income side with the pipelines. So I still think it's in a spot where you can do a lot. But generally, we screen a lot of stocks, screen about 300 stocks. But if you look at it, we look for various things of, say, whether it's a value or where we want to buy it, and they're just not there. If they were, we would buy them. But a lot of the companies that are really, really cheap right now are cheap for a reason, and that's because business is really bad. So you have to be careful with it.
Let's go into energy a little bit more specifically on some of the companies that you're talking about. I mean, it seems to be a sector that's very much hated at the moment. We see this volatile activity, and then we see oil prices as well. We have what's happening in the Red Sea. So talk to me about the opportunity here. I mean, energy companies undervalued right now, and where do you see this forecast going for this year?
Well, we said all along, Jeremy, that what happens is there's been a mismatch of timing on what people thought you would go to green as opposed to fossil. That's been a big, big mismatch, and I think it's still really mismatched worldwide. And so one of the things here, supply demand is really coming to a head where it's 1-to-1, and the Mideast won't help you either. But the biggest part of it is that when you look at it, you're in a position to where these companies probably it's going to be a tough situation. You'll get in this maybe the next three years where natural gas and oil are in bigger demand than what we can supply. And we just feel like these companies offer a place to be. I remember the markets back in 1977. The market went down all year long, all markets, but oil went up. And so it can go against the grain on you sometimes, but there's some good cash flow pieces and energy as well.
Yeah, and it seems like dividends are also there. When you look at the oil and gas sector, why do you think it's been so undervalued? I mean, was there too much off the top about the green conversion, this green economy? And then, of course, all this inflow of cash went in for research and development. And now people are saying, wait a minute, we actually need the traditional carbon. We need oil and gas.
Well, I have to say that most public companies are sort of lemmings in nature. They just do what they think everybody else is doing. And I think they bought it hook, line, and sinker that, hey, we need to do this, we need to do that. They really didn't think about it as much as they should have. And so now you're in a position where we're backtracking, going the other way. If you look at annual reports and all sorts of things, they're dropping ESG, they're dropping a lot of things that they were talking about before. But what happens is you need fuel. I mean, you can't run an economy, you certainly can't run the world economy without energy. And the main source of energy right now is oil, natural gas, and coal. We're not big fans of coal, but I'm just saying that's what you look at worldwide. And I think that's where people missed it. They thought it was in vogue to go the other direction, but then they realized that, hey, this won't work.
So talk a little bit about some of these companies where you think they might be undervalued, where there's a potential opportunity to pick up some of these shares. I mean, we're seeing a ton of them in the red today. We've seen them in the past month. Do you think this is a 1-2 year strategy? If you just remain long here, obviously we're going to see some corrections.
Well, they could correct more. I know when we go in to buy things, we start out with 1%. We don't bet the farm on each name, but if you look at what we own on the E&P side, we own EOG is one company, Northern Oil and Gas, company called Williams Brothers. Then on the gas pipeline side, particularly in the MLPs, we own Enterprise Products, Energy Transfer, MPLX. When you put all those together, Plains, you put all those together and they're paying you about, really about probably 8.25%, 8.5% on a K1. It's better than real estate today, in our opinion, anyway.
Yeah, absolutely. Before we get into real estate, I want to talk about specifically tech equities here. I mean, the S&P 500 has recently rallied. The Magnificent Seven has kind of been holding their spots here. Do you think, Ted, that we're a little bit overvalued here? Is there a correction coming? I mean, NVIDIA is down today, selling off before they report earnings this week.
Well, Jeremy, you're over 21 times on the S&P numbers right now. And you can't, we've always said all along, it's going to be very hard to start a new bull market. Now, you may get a blow off top in here, but you don't start a bull move at 21 times earnings. That means they're already at the upper end of where they should be. So I don't think it's a start of something new. And it looks exactly like the first quarter of 2000 to me, not much different. We had very similar stocks at that time, very similar multiples at that time. And these were companies that, you had to own for 20 years. It didn't work out that way. And I'm assuming that we're now gone from maybe the Magnificent Seven to what we think maybe the Magnificent Four. And so we own a few of these. We own a little bit of them. We've owned them for many years, but we've sold enough to where we're down to smaller pieces now.
And what do you think about that market looking forward for the outlook of 2024?
I think they're fully priced. I think you could get, we felt like all along in here, we wrote in our January comments that we thought the market would hit a new high just because you were within striking distance. And I think that's what's happening here is that you push these markets in. It's a lot of chasing going on, and we've seen it all the way around it. And so it has all the signs of everybody's in. And usually that's how these markets top. They go back and forth some, you'll hit a new high, but you don't have an extreme new high. Like if you went back and looked at where the markets were in December of 21 and where they are today, okay, if you bought a 90-day treasury or 6-month treasury, you still made more money today than you would have of where the markets are today. So you have to stop and think about what you have here.
Interesting. Given the Federal Reserve's indication to hold Fed rates at around 5.25%, 5.5% until mid-2024, maybe even later in the year. What's the impact of borrowing costs for consumers and businesses here? And I'm curious how this is affecting them. I mean, we've been hearing credit crisis. Where are we at?
Well, Jeremy, I'm involved quite a bit in a community bank too, so I know quite a bit about lending and what goes on with various people. One of the problems you had is when you first raise rates like that, most situations, companies, deals, real estate, they have enough money to pay those higher rates for a while. They've got money in the till. But you get out another 12 or 15, 16, 17 months, and they run out of cash. That's really what happens. It happens in every cycle. And so when they run out of cash, that's when you start to see them go back to the banks and say, you can have this property back, or, a resale. A lot of things happen at that point in time. And I don't think there's anything, to change that at this point, because the prime's still 8.5%. And a lot of people are borrowing, small businesses borrowing at 9.4% right now. So they better have really good margins if they're borrowing like that. And then in addition, you still have about a 7% mortgage rate right now. So we're not in a position where, you can say things are really off to the races in that particular area for sure.
Mm-hmm. Give us some insight into the banks then. I mean, you talked that you work with one. I'm curious, is there some cracks here? What are you anticipating in the banking sector?
One of the things I would say, Jeremy, I blame a lot of this on the Fed itself and the powers that be. They came in after the GFC and wanted more and more banks to shore up balance sheets and buying treasuries, because they wanted to buy their treasuries. They needed to sell them. Mm-hmm. So a lot of banks bought treasuries. They were sort of impressed upon to do it. Then they got in the treasury market, and of course it backfired on them. And then they have, they have commercial real estate too. So it depends on the bank. If a bank does not have a lot of bonds and they don't have a lot of commercial real estate, they'll be just fine. They're going to be able to do steady business as they go along. One of the things you run into here, though, is if in fact a bank, and I don't feel like our bank is like this, but if in fact you see a bank that's having to take some big write-downs on loans, then they're going to have to sell those treasuries to reliquify. And when they do that, then they've got to take a charge to capital, and then you're in trouble. And that's what people need to understand about the system right now.
Yeah, I mean, we saw Jay Powell talk a little bit about the banking system, talking about maybe some consolidation. Maybe there would be a couple that would have problems, but do you think the overall resilience is quite strong?
Well, I have to tell you, if you watch 60 Minutes, he reminded me of a couple of other Fed people right before the recessions who would say, well, I think we're fine. If you look back in '07, they were talking about the fact that hey, we think this subprime is totally under control. You won't have to worry anything about it. And I noticed he said in the 60 Minute situation that I think we really have commercial real estate generally under control. Mm-hmm. They probably don't know, honestly.
So are we heading into a recession then here, Ted?
Well, I think the odds are still 50-50, that you go into recession. We thought in the early part of last year, and we were wrong, that we would have weakness by the fourth quarter. It didn't work out that way. And I think it didn't work out that way because the Fed decided, hey, we've had enough pain here. We're going to give everybody a lollipop and tell them that things are going to be okay, and we're not going to raise anymore. Well, that doesn't necessarily mean they're going to lower anything. And so if you don't lower anything, then you're still going to be in the mud for a while. And I think that's where the 50-50 comes in. You'll just have to see how that pans out over the next 3 or 4 months. Maybe not go into it, but I don't think we have enough evidence to say that we wouldn't at this point.
Right. And when do you think that Fed cut could come? I mean, the markets are pricing in only a couple now, but do you think it's going to be later on in the year?
Well, obviously, I don't know, and I wouldn't purport to know, but I would tell you this. If you look at the numbers that came in January, PCE, CPI, and it looks like they're going to be similar in February. That means March is out, probably May is out, okay? Then you get into the summertime, and I'm not certain that they would want to start lowering rates in the summer or late summer when you're just before an election, and I don't think, maybe they would, maybe they wouldn't, but I'd have to say there's probably a 50-50 chance there too that they didn't lower at all. Maybe, I guess we'll just have to see how that works out. But if you look at how hard it is to hire somebody right now and what's going on with those increasing prices and that sort of thing, I don't see how they can come in and really get aggressive on the downside. And you've got a 3.2 unemployment rate right now. Can you imagine this? So I'm going to juice the economy and lower rates. Then people can't hire anybody because everybody, wages are up 5.5%. Yeah. So that's 2 points over inflation. So all of a sudden you're looking at 7% or something. And so I think they're caught in a squeeze right here. So I would say they probably do nothing, but we'll see, I guess.
Yeah, you're talking about consumers, and as the consumer spending is expected to grow at a more subdued pace, obviously due to factors like diminished savings and plateauing wage gains, which consumer sectors do you believe will be most impacted here? I mean, what's your advice to investors keeping an eye on this?
Well, I think what's happened, you have a bifurcated market. You have the bottom 90% and the top 10%. And the bottom 90 is just barely making it, just week to week. I mean, I always say I grew up like that, so I know I can ask the right questions to find out how they're doing, and most of them are not doing too well. And so you look at auto delinquencies, all delinquencies for that lower end or higher. And so they're getting squeezed quite a bit. Whether they can pull through it or not, I don't know. But if you look at buy now, pay later, keeps going higher and higher. You're 22.25% on charges on credit cards. I mean, you would think if you wanted to really help the country, if I were in charge up there, I'd say, why are you charging 22.25%? But that's just me.
Yeah, just you. I'm curious, is there any sectors that could actually stand to benefit from these conditions, though, offering a counter narrative to the broader slowdown?
Well, I think for certain, income will, because if you have cash flow, no matter whether it's on a common stock or on the bond itself, now we only primarily own short-term bonds, I'd say less than 60 months, but still cash flow will be meaningful in that period. Because if you can't get as much growth out of a company, if you can still get the cash flow, that's what's most important. I think people forget cash flow is the driving engine of every great investment. And so that's where cash flow would probably still do well. And if you look at it today, I don't think people realize this, but yes, the Dow Jones and the S&P have hit a minor new highs, but the transports, which show the economy, they've never hit a new high, and utilities are almost at a new low. And then you have the NASDAQ, believe it or not the NASDAQ 100, but the NASDAQ also has not hit a brand new high. So you certainly have some bifurcated markets. I think individuals are caught in the middle of it, which unfortunately, they always are.
Yeah, always are, it seems. I mean, the retail audience that you're talking about, those investors, should they be looking more closely then at things like utilities and transportation, things that haven't really moved with this recent rally?
Well, they could look at utilities, I think. I don't think that's a bad buy here, except that, if you can get close to 5% on a one-year treasury, and let's say 3 to 6 months, you can get 5.20, 5.25. I guess my point would be to somebody, until they can clear the air a bit, why waste your time on trying to guess when something's going to happen when you know what you can get in something that's really safe, and go that direction, really. And then if you do get a setback, then go looking for some really great common stocks.
Yeah, interesting, Ted. You talked a little bit about real estate. With the housing sector experiencing a significant drop in activity due to obviously the higher mortgage rates here, how do you assess the future of real estate investments? And what was the advice that you'd give investors currently holding or considering some real estate in their assets?
Well, I think we pushed, Jeremy, the home ownership thing so far that people have this idea if they don't own a home, they're not worthy of being a human being or something. I see that all the time, where people that really shouldn't be buying a house, they should be renting right now because they don't really have the money. And we pushed that narrative so long that people feel that way. And it's a vicious circle right now. 25% of the homes being sold right now, new homes, are to commercial people buying and renting. They're buying and then they're renting them. That takes the other side of the market, the people who are trying to get into that market, it takes them out of the market. And then they have the 7% top on the mortgage. So see how that circle keeps you just spinning around and around and around, and you keep people renting the ones that they're buying. And that's what I think is wrong with the marketplace right now. As far as existing home sales, they're sort of non-existent.
Yeah, you're not kidding. And when you talk about commercial real estate and obviously office vacancies, we're seeing some news flow into this part too. I mean, you obviously have your head to the ground here when it comes to real estate and prices being connected to this bank. Talk a little bit about commercial and office.
Well, what happened is I think people forgot about, they didn't realize that the remote work thing was really going to stick. I thought it was just a COVID thing, and it stuck, and it changed the lifestyles of so many people. And I think the fact that you could have great broadband and work from home and do a really great work and that sort of thing, that's changed the system. And it really threw these people off. And they had built all of this in advance, and they had a lot of things on the books here. But if you look at the number of empty space today and subspace is a big part of it that's out there. I don't think there's any way that for years that they'll recover without what I call recalculating. In other words, I'm going to resell this building and lose half of it, price-wise, and then somebody else starts over at the low level and maybe they can make it work. But that's where we are in that system right now. And then now we're starting to see some people choke in the multifamily business too, because the rates are catching up with them now. So, and the rents are falling off a little bit. But commercial real estate looks like it will be a long time before you really get that straightened out.
Yeah, what are your estimations there in terms of the market? I mean, in terms of timing, it's pretty wild to walk downtown into various cities and see it black.
That's true, Jeremy. And one of the things that I would recommend to people is over this next 3 or 4 or 5 years, keep your opportunity hat on. You may be looking at a building, maybe it's not a 20-story building, but maybe you may be looking at a neighborhood building that's 4 or 5 stories high, that has really good renters in it. Everything's okay. It just got over leveraged for some reason. And you may end up really looking at something that's really great to own. I like real estate. I just think it got overpriced and overbuilt. And so you have to pick and choose on it. But there could be some opportunity in that next 3 to 5 years.
Yeah, it seems like the opportunity is abundant there, especially if you're liquid. A lot of institutions looking at that too. What is your projection here for the market in, say, the short term? Before I let you go here, Ted, what should we be watching for over the next 2 months?
Well, one of the things you want to watch for, when you get up in this new high territory and we feel like, again, that's sort of a rolling top. I've seen it before. You'll go up and down. You'll have a day like today that's down, and then tomorrow you'll go back up, and you'll start volatility picking up at the high. They're in the highs, but they pick up. And then you'll notice one day that makes a little bit lower low and a little bit lower high, and it sort of works its way off. And then all of a sudden you'll notice instead of the, what I call the Mag 4 now, they start to shrink a bit as well. And when you see all that coming together, then you'll know that, the bloom is probably off the rose, but that's what it looks like at a top.
Mm-hmm. And at these haircuts, when they start to dip a little bit lower, are you buying that low? Is there some generational wealth to be made here?
Well, I don't know, Jeremy. I never know what's going to happen in the market. I just know that I know the levels that we would buy things. And when we screen out things, we have a price we would pay. If it happens and the market was down 10%, we would buy it. And if it happens and the market was down 40%, we would buy it. And we look at the companies as opposed to kind of a broad market thing. But I do think out of here, if you do make a top, and that's, again, I don't know that we would, but I think we could. If we did make a top and you get selling, I wouldn't be surprised if the selling didn't come fast and furious. If it doesn't, and things are sort of shaking out like no landing or something, then you'll probably just, put another high on this thing, and they'll really blow the top off. But I really feel more like we'll have some selling before that. But when you get that selling, we always buy into deep sell-offs, and so I don't know we'll get a deep sell-off, but if they're selling them, we'll be buying them. I'll put it that way. That's usually the way it is.
I like it. So much to unpack there. Ted Oakley, Managing Director at Oxbow Advisors, joining us today. Thanks for coming on to share your insights with the audience. Appreciate your time, Ted.
You bet, Jeremy. Thanks.
Thank you, sir. And thank you for watching. I'm Jeremy Szafron for Kitco News. Don't forget to subscribe to our channel and visit kitco.com for the latest.